Welcome everyone as you start to come in. We'll give everybody a second to get into the webinar before we get started. Welcome in everyone. Thank you for joining us today. My name is Lakeisha Barclay. I'm the Executive Director here at Rubber Division ACS, and we are pleased to bring you our 2026 economic update. I am going to introduce our moderator for today, our 2026 Rubber Division ACS Chair, Russ Vogelsong. Russ has been in the industry 22 years and still says he is a rubber baby, according to our longevity within the industry. Russ is currently with Quanex, and he's a senior technical sales and service engineer. Russ, I will turn it over to you to introduce today's speaker.
Awesome. Thank you, Lakeisha. Well, good morning, good afternoon, and good evening to everyone, depending on where you're dialing in from. Thank you for joining us for today's Economic Update webinar. Before we begin, I'd like to extend our appreciation to the HF Group for sponsoring this webinar and helping bring this valuable content to our industry. HF is a leader in sustainable solutions for rubber and plastics processing. With 1,885 employees across 15 locations worldwide, the company serves tire manufacturers and producers of technical rubber and plastics goods. Its commitment to innovation and sustainability drives the delivery of reliable, high-performance products and services, including mixing room systems, curing presses, and digital solutions that exceed industry standards. Backed by the expertise of its teams, HF Group builds long-lasting partnerships focused on customer success. It is my pleasure to introduce today's presenter, Connor Lokar, Senior Forecaster and Keynote Manager at ITR Economics. Since joining ITR Economics in 2014, Connor has helped business leaders across North America make informed decisions about growth, profitability, investment, and risk through data-driven economic forecasting. Connor specializes in translating economic trends and leading indicators into strategies organizations can use to navigate changing market conditions. Please join me in welcoming Connor Lokar.
All righty, Russ, thank you so much. And Russ, if you're a rubber baby with 26 years, I'm not sure what that makes me, but I guess we'll worry about that later. But great to meet everybody again. I'm Connor Lokar, Senior Forecaster here with ITR Economics. And we're going to be breaking down the economy here for you over the next hour or so. So just a couple of housekeeping items. We are going to have the opportunity for Q&A at the end. What you're going to want to do is try to leverage the Q&A function. There's a chat box and there's a Q&A box. Try to put your questions in the Q&A box if you can. If they get mixed up, that's not a big deal. We will cover that in the last 5-10 minutes of the presentation. I saw someone did ask as we were getting going if you're going to get a copy of this presentation. We're certainly happy to share a PDF of the presentation as we go through, but please feel free to take pictures as we go through. If any key slides come up that you like, certainly do that, but we do like to share these with attendees. Typically happy to do that. So again, about me, I've actually been with ITR Economics for 12 years. I hit my 12-year work anniversary last month, which I know is ironic because even digitally, I look 12 years old. But I have been serving as a keynote presenter on the road or in virtual functions like this for the last 11 years, as well as an economic consultant. So ITR Economics, what we do is very unique in terms of how we break down the economy. We are not academic economists. I'm not coming to you from some sort of university or higher education environment. I'm not a government economist. I don't work for the Federal Reserve or the Census Bureau or anything like that. I'm not a talking head economist, although I guess today technically I am. You can see my head in the some corner of your screen, but I'm not a TV made for TV economist. We are really economic consultants. We leverage data, and a lot of the data I'm going to share with you today to help businesses better understand where they are and where they're going in this economic world. And we create customized forecast solutions for manufacturers, distributors, retailers, businesses large and small. But the great thing about economics is even if you're just a person listening today, there's going to be some nuggets for you to think about as you consider where you are, where your family is. You think about your kids, your parents, whatever else. We're going to cover all the good stuff today. So before we jump in, one thing that we always like to do at ITR is take a very quick look in the rearview mirror before we look forward. So what you're looking at here is a snapshot of our forecast results for 2025. So basically what I'm showing you is what did we say was going to happen last year? What actually happened last year, and how close were we? So you see two columns there on the right next to a bunch of data series, U.S. gross domestic product, U.S. industrial production, some foreign series there, some U.S. Segments of the economy like the consumer, the housing market, the labor market, so on and so forth. So the accuracy column is fairly intuitive, but I'm going to explain it anyway. Basically, those numbers, that is measuring how close were we. Specifically, what was our median stake in the ground target for US GDP? We said the US economy is going to do this. And then what it actually did ended up being 0.3 of a point off of our forecast expectations for 2025, which we felt pretty good about. And then you can take that on down the line. Now, the middle column, much less intuitive, so I'm definitely going to explain that one. So each of those numbers, 18, 16, 20, 15, 22, whatever it is, that is the number of months, specifically the number of months prior to the end of 2025 that forecast was put in place. So when you see 18 there next to GDP, that is the forecast that we were leveraging 18 months prior to the end of 2025. In other words, the outlook we put in place in the third quarter of 2024. Now, I highlight that point in particular because one of the things that is a differentiator for ITR in the world of forecasting is not just our accuracy, but also what I guess I'll call the durability of our forecasts, where we are accurate a long ways out. And I think all of you listening could appreciate quite likely that, I'm sure like it's nice, right? If I can tell you in November 2025 where the economy is going to be in December 2025. But at the same time, I think we all realize that's not really that valuable, right? Like just, a 30-day heads up isn't really enough time to meaningfully pull levers and really shift our posture either defensively or offensively. How are we handling our business? Budgets are already set. The year's already done. If I'm a manufacturer, my backlog can tell me where I'm going to be, 30 days from now. But if we can be accurate in November 2024, or in the case of GDP, July 2024, where we're going to be in December 2025, all of a sudden we're starting to cook with gas there. And we're starting to, really, if we can rely on these insights that we can leverage in a 2024 budgeting cycle for the upcoming year, that starts to become really meaningful. And historically, that's what we're able to deliver at ITR. Now, I don't want to go through all these or spend too much time on this, but I do want to call out one here. If you can see my cursor, that 91.2% there next to the single family housing market. So I'm sure a lot of you just kind of glazed up and down that column. You saw a bunch of numbers starting with a 9, so you saw a bunch of A's and 91.2 there. You probably thought, oh, well, that's an A minus. That's pretty good. That is not an A minus. That's actually an F for us at ITR. So what that's basically telling us is that the housing market deviated from our expectations by 8.2% for 2025 versus our mid 3Q 2024 expectations. And specifically, it underperformed. And I call that out specifically because I want to be transparent with you, right? Like I want you to trust me. I want you to believe in ITR. And I don't want to pretend like we're perfect because perfection in the world of forecasting is not possible. Very good is possible. And you can see we hit very good on most of the data sets on here, but we do have our misses from time to time. And when those misses occur, we like to understand why did we have that miss. We think we understand why. And then, of course, we adjust that forecast as changes are needed. So we did change this forecast last year as things were going wayward. But if you saw me in, say, August 2024, July 2024, housing didn't end up doing what we wanted it to do. But at the end of the day, is the tagline there at the bottom reads, trying to just reduce risk and drive some practical and hopefully profitable business decisions for us, whether it's in business or again with our families, just having a good idea of what's coming next. Like I want to take surprise, off the table for you because economic surprises generally aren't fun, right? They come in the form of recessions, geopolitical black swans, wars, things that just create a lot of anxiety in our personal lives and our professional lives, um, and I want to try to diffuse that if I can today. So preamble over with. Let's get to the good stuff here, folks. I'm not going to bury the lead because I'm sure a lot of you, sign up for this. Oh, Economist is coming on. What is he going to say? Is the world ending? Is it not ending? Is it the best ever? Is it the worst ever? The economy is growing, and we expect that to continue. So when we look at U.S. real GDP, U.S. real gross domestic product, what does real mean? That means it is inflation adjusted in the world of economics. So when you see real in any title, that means we are basically adjusting for inflation. And we do that because I think, as you can all appreciate, experiencing inflation over the last 5 or 6 years, if you buy the same amount of stuff and it costs 5% more than it did last year, that reflects a 5% increase. But is it really, right? Are we actually doing more, making more, purchasing more or not? Or are we purchasing the same amount or potentially less and it just costs more, so that reflects. So we want to smooth that out. And the blue bars here historically, that is GDP all the way back to 1970. Pretty simple interpretation here. Rise in the dark blue lines, that is a rising economy. Decline in the dark blue lines, that is a contracting economy. Those are recessions. Most recently, you see this jagged COVID dip here. Less recently, we see the 2008, 2009 Great Recession, which I suppose in this chart framing, for those of you that remember, it doesn't look all that great. It doesn't look all that scary on the chart, but that was the worst recession since the Great Depression that the U.S. economy had experienced, and really the global economy had experienced in nearly a century. And if you go to the bars here on the right-hand side, this is our forecast projections for the coming year. So what we saw looking at 2025, our projection going into the year was that we would see a 2.5% annualized increase. Going back to that mid-24 forecast, that compares against an actual outcome of 2% growth. And just kind of think about that for a moment. So think about ITR's forecast. Like, take yourself back to early 3Q 2024. That was before the U.S. presidential election. That was before the ultimate inauguration of the new administration. That was before the trade war. That was before the shutdown that we had late last year. That was before so many other things that happened last year. And through all of that, we did see the economy come in a little bit light relative to our expectations, but still we were looking for a mid 2% growth rate. We came in at 2. We were satisfied with that, and our forecast for 2026 is 2.1% growth, and then consistent with that in 2027. So essentially, how I would describe the economy today and going forward very simply is it's good. It's reasonably good. Is it great? No, I wouldn't go that far. Is it the worst ever? I wouldn't say that either. And you've probably read headlines giving it, describing it in both ways in the last several months. But I think what should comfort you is coming into this is that there is no jagged recession here. We do not think that the economy is going to crater in 2027. We do think it slows down. If you've got a keen eye, you'll notice that the slope levels off a little bit next year. We're looking for some plateauing activity, some slowing activity, but nothing I would go as far to attribute the recession word to at this point. We think that the economy is going to cool somewhat slightly next year, some deceleration, slowing growth, which I always like to remind folks, slowing growth is a 2-word phrase, and the second word of that phrase is growth. So deceleration next year, but nothing too ominous at this point. So that is our expectation going forward. Now, that's from a GDP standpoint, and I don't really like GDP as a data set for a couple of reasons. The primary reason is it's too big. It is basically trying to characterize the entirety of the US, in this case for US GDP, or it could be for China's GDP trend or for European GDP trends. It's trying to basically distill the entire economic experience of that nation into one data point. Which is really hard to do, right? Because we're just kind of painting the economy with an exceedingly broad brush. And, is GDP going to perfectly describe what's happening in the automotive market, which then obviously is going to affect what's happening in the tire market or the broader rubber and plastics market? Not necessarily. Like, sometimes it does, but sometimes it doesn't. And another critique I have of this data set is GDP includes government spending. And what that really means is if the private sector is contracting, but we spend enough and print enough and borrow enough money at the public sector level, you can kind of make your own math as far as GDP is concerned. And we've seen that happen before as well. So I don't love it, but I know that you guys read about it, and the news and the talking heads like to talk about it once a quarter when the new data comes out and foam at the mouth on TV and get you all freaked out. So for those of you that want just an unbiased, grounded perspective, the economy is growing at what I would call a good, reasonable, okay growth rate, and we expect that to generally continue as we go forward. So for those of you that are rooting for the quote-unquote rising tide or generally lifting macroeconomic environment, that's what we expect, although a little bit less exuberant next year. So let's take a look at the global economy here, and specifically we're going to talk about oil. Now, I kind of wish we had this presentation a week ago because some things have happened overnight, but we'll cover that in a moment. But one of the things I want to do very quickly is just explain to you how we manage the data at ITR. So like I said, I basically have two jobs. Speaker is job function number one, where I'm either doing keynote presentations on the road. I'm going to be in Cleveland, or excuse me, Cincinnati for a presentation next week. I'm going to be in Austin, Texas, and then Wisconsin the week after that. I go all over North America. Occasionally I go to Europe for these keynotes. Also, I do webinars where we can talk to folks all over the world from the comfort of a desk chair. But we also do consulting work, and where we leverage economic data to create customized forecasts for our clients, where we essentially project their business for them that they can use as an input in their budgeting process, their longer term and shorter term strategic planning and resource management to make sure, are they understanding where they are in the economic cycle and making appropriate decisions based on that. Now, I frame it that way because whether or not I'm forecasting a $2 billion manufacturer or a $20 million small business or a $500 billion market data set, the process through which that we manipulate the data is all the same. So I'm going to take that through that. I'm going to take you through that very quickly because it's going to just help you better understand some of the visuals that you're going to see here coming up. So any data set, whether we get it from the government, from private data providers, from member companies or client companies that we do forecasting work on behalf of, if we're getting their revenue data, their bookings data, their volume data. Sometimes they want us to look at pounds, tonnage, feet shipped, whatever it is. It all comes to us in the same format, right? Where we have a data value by month. It could be retail sales, could be housing starts, could be revenue, could be shipped volume. And in a raw monthly data format, what you're seeing here, this is just example data to illustrate the point. You see nothing, right? Like it's just a bunch of numbers. It's like, okay, I see a bunch of sixes at the top. I see, we'll call these millions for this exercise. I see 7, 8 million at the bottom. So it's like, I think this business is growing, but I'm not really sure. So what we do is we generate what we call a 3-month moving total, which we're looking at values compared to the same time a year ago. In the same quarter 1 year ago. There's an issue, unfortunately, with the data here in this column, so ignore this for now. But what that does is creates a quarterly rate of change. And what that gives us is a quarter over quarter comparison. So when we see 12.2%, that tells us over time we can see these rates of change are accelerating, rising higher. This is an accelerating revenue trend. We then take that one step further. We generate what we call a 12-month moving total. This, more of you should be familiar with. This is where we just sum the most recent 12 months together. So this is your rolling annualized sales trend, bookings trend, data trend for whatever market data set we're looking at. This business, again, example, shipped, recognized 87.2 million over the last 12 months with data through May. Because of the holiday, our team's a little bit behind. We don't have June data just yet. So we're looking at May to May, and then we compare June 24 through May 25 at 81.5 million. That reconciles to what we call a 12-12 rate of change. And this is your CAGR. This is your annualized rate of change. And we can see these rates of change are rising and accelerating. And then ITR comes in, and we want to know, what is that 7% going to turn into at the end of this year, at the end of 2027? Is that going to go from 7 to 17%? Is that going to go from 7 to minus 10% in a contracting trend? And obviously the decisions that we're going to make as an organization or individual are obviously going to be pretty greatly affected by that, right? Like, are we adding people? Are we adding capacity? Are we buying new machines? Or is it going to be a little bit tougher than that? We're being a little bit more defensive as we go through. So That's what you see here on the screen. So both of these trend lines here are what we call 12-12 rates of change. So again, this is your annualized, your 12-month on 12-month growth rate. So when we see 1.2% here in the dark blue line, what that is telling us is that U.S. industrial production is up 1.2% over the last 12 months. That is good because that is a positive number. As you can see visually, that is a positive number that is rising up above the zero line here. So that is an accelerating growth trend here for the U.S. economy. The light blue line, this is world industrial production. Then we see a 3.1% growth rate there. So what that's telling us is that the global economy is growing a little bit faster, which is fairly typical, as you'll notice, because again, this is leveraging a lot of emerging market data. The U.S. economy just had its 250th birthday. We are a mature, a very large economy. So moving our economy forward at a 3% pace is pretty challenging in a modern context. And, save for coming out of a pandemic with a ton of stimulus, generally we're going to see our growth rates are going to be between 1 and the mid 2% range over time. And so industrial production is a data set I think a lot of you are probably less familiar with because you're not going to read about it on your favorite, 3, 4, 5, letter news networks on TV. Even if you want to see it like on the Wall Street Journal or something, you're going to have to dig for it. They kind of stick to the sexy big ones, right? Like let's freak out about what is the CPI doing? What is the stock market doing? Let's talk about GDP once a quarter. These are valuable data sets because industrial production as a data set, it basically lowers the scope. So GDP tries to look at the totality of the US economy. IP tries to look more specifically at the physical goods side of the economy. So when we think about chemical product production, when we think about rubber product production, when we think about tires, when we think about cars, when we think about pharmaceutical products, those are encompassed in this data set here. And so when we see these colored lines above zero, that is expansion. That is expansion of the physical goods economy, which is refreshing because if you track my cursor down and to the left, what we see is the economy was not growing, at least domestically in the US, for basically 2 years. We saw a 2-year recession basically characterizing the majority of 2023. All of 2024 and into early 2025, we basically saw that the physical goods side of the economy was contracting. And that means, again, volumes were going down in terms of manufacturing for most products. And it was pretty natural and normal to see that coming out of the euphoric, frothy 2021, 2022 post-COVID hysteria induced by stimulus, massive, massive government spending and borrowing and pent-up demand. And then all of a sudden, 9% inflation showed up in 2022. The Fed started to crank interest rates higher. Consumer savings started to get beaten down. Inflation-adjusted consumer income started to roll over. And people basically started to buy less stuff, which means people needed to manufacture less stuff, which ultimately cascaded negatively through the economy. And again, you can see some of those aforementioned recessions here. We see 2020, the shutdown here on the screen. You'll notice domestically in the US, we had a recession in 2015-16. That was the oil and gas recession that affected the United States more so than the global economy. And then, of course, 08-09 at the far left here for those of you that remember on the left-hand side of the screen. So one of the challenges that we've been dealing with for the last 2 years has been a very elevated level of uncertainty. And uncertainty is venom to the business community in particular. It also affects consumers, but particularly when we think about CapEx and big purchase and investment decision making, what you would like to see is an external market regulatory economic environment that is stable and not creating fear. And we really haven't had that for the last 2 years. So this dark blue line here, this is the U.S. Economic Policy Uncertainty Index. This is a rare chart from an economist where up and to the right is a bad thing on this chart because surging uncertainty is a great excuse to do what? Nothing, right? It's a great excuse to not spend money, to not take risk, to go into the bunker, to batten down the hatches and say, well, the news says the world is going to end because of war with Iran or because of a trade war or because of insert any other number of issues we've seen in the past. And to a certain extent, perception can become reality in some aspects of the economy where we see this surging uncertainty. And we saw that plague the economy last year. This surge here, this was trade war uncertainty in the tariffs and Liberation Day. And, the surprise, we're tariffing everyone all at once at exorbitant rates. And then a couple weeks later, it was like, okay, actually, we're going to pause that, but they're going to come back. And that push-pull created a lot of uncertainty in the economy last year. Then as we got into late 25, early 26, it was like, okay, we're starting to, the economy didn't collapse. We didn't get hyperinflation. It wasn't ideal, but we survived. We were plodding along, doing okay, still elevated relative to, say, pre-COVID uncertainty levels or kind of interim 23, 24 uncertainty levels, but we were getting there. And then almost identical timing to the trade war, we had actual war with Iran, and that created new uncertainty, which we are still dealing with. And that has been a headwind to the economy. And so most specifically, we'll talk about oil here today. So as you can imagine, oil price shocks create a significant upside risk to inflation. And the primary question is the duration of that shock in terms of how problematic is or is it not going to be. So the dark blue line here is the U.S. crude oil spot price trend. This is domestic U.S. pricing. So this is WTI, not Brent crude. And we are showing this to you on a 3-month moving average basis. So what we're looking at is the rolling quarterly average pricing. So you see 97 there and you'll say, well, Connor, oil's in the 70s today. Yes, that's fair. This is telling us what did oil average over the last 3 months, specifically April, May, June, the last full 3 months. And it averaged $97, $98 a barrel in the second quarter. So the diamonds here is ITR's pricing projections through the duration of 26 into early 2027. The light blue line is the U.S. dollar broad nominal trade weighted exchange rate index. Practically out of breath just saying it. Basically, this is a dollar strength gauge on an inverted basis. So what that means is this light blue line declining over time. This has been a secular strengthening trend in the U.S. dollar over the last, call it 15 years or so. And then this slight rise that we've seen over the last couple of years, this has been the U.S. dollar getting a little bit weaker over the last couple of years, but it has weakened so much that it's exactly where it was in 2024, in 2023. So on average, again, that will be vary by currency, but we still see a generally very strong dollar, particularly compared to where it was 5 years ago, 10 years ago, 15 years ago. But that's not the point of this chart. The point of this chart is oil. So as you might imagine, ITR revised our oil price forecast back in March as events on the ground were unfolding. And what you see on the screen here is the result of that forecast. So our forecast back in March was that oil would average roughly $97, $98 a barrel in the second quarter, and it did. Our forecast was then is that oil normalizes itself back into the low 80s for the third quarter, and then back into the mid-low 70s by the fourth quarter and first quarter of next year more durably. So we had a pretty good start, right? We saw a tentative ceasefire that doesn't seem to be going well in the last 36 hours, where oil actually rolled all the way back into the 60s. And then as of today, I'm just going to peek off screen here. I believe we're back into the mid 70s. So that is all fine relative to our forecast. Oil is actually lower than we thought it was going to be this early. So essentially what we expect is low 80s on average for the third quarter. If it's lower than that, that's good. If it's right there, that's in line with our forecast. Higher than that would be a problem. And then more durably sustaining in the mid-low 70s by the end of this year and early next year. So if that is the playbook that we follow, or better, like I said, or if it actually stays in the 70s through the balance of the third quarter and then gets back into the 60s durably, that would be even better. That would be a diminished cost pressure, fuel cost pressure, a diminished consumer risk. But as things currently stand, we do not view this as a fatal macroeconomic event. It's not productive. It's not ideal. I would have preferred not to see it, but we don't think it kills the U.S. economy. And one of the reasons that we feel that way is what we want to do is look at oil and specifically adjust it relative to earnings. And we do that because $100 oil today relative to today's earnings is different than $100 oil in 2022 when people earned less, or $100 oil going back, say, if I back up one year, if we go back to 2022 or right near it in at times in the early 2010s or north of that in 2007 into 2008. This was very punishing back then because people didn't make as much money nominally as they do today. But when we adjust the cost of 22 barrels of oil, and you might say, why 22 barrels of oil? That is what the EIA has deemed to be the quote unquote normal annualized consumption volume for your normal consumer in the United States. And when we look at it relative to today's earnings, what we see is that before the war started was amounting to about 2% of median annual earnings. Now that number's gone up. The diamonds is our forecast here that it's going to float up to about 3%. That is not as much consumer strain as, say, the initial beginning of the Russia-Ukraine war, where it pushed that percentage north of 4.5%. Obviously, we went down to about 1% in 2020 when much of the country was locked at home and not flying on planes and not driving into work and so on and so forth. And nowhere near as acute the pain that we saw, say, in either 2008 or the late 1970s, where it was north of 6, nearly 7, or north of 7, nearly 8%. So this was a factor we were considering earlier this spring where we did not join the chorus of hysteria in the news and say, well, oil's $100 a barrel, and we know that that's generally a bad thing, so it's time to predict a recession. We weren't prepared to do that at ITR. We wanted to hold our water a little bit and see how things played out. And not last 24 hours notwithstanding, it seems like we are going to dodge catastrophe here. So from a supply chain standpoint, obviously this has been highly disruptive, and I think that the chemical and rubber industry can certainly appreciate that. And this is a 7-day moving average of trade volume through the Strait of Hormuz. And as you can see, it was generally out like a light as this conflict started, and it's taking some time for that to normalize, and we expect that it will take time to normalize as we go forward. Now, a lot of Middle Eastern crude has been rerouted through other pipelines to get to other ports and other region exiting opportunities. So I think it's improbable we actually see this get all the way back to normal pre-war volumes, but it certainly is and will need to get higher than this for things to truly get back to normal as we look forward. But it's something worth paying attention to, right? Because when we look at oil prices on a monthly basis versus income, so this light blue line, this is U.S. real personal income, excluding transfer receipts. Transfer receipts are things like direct-to-consumer stimulus or Social Security and things like that. So we exclude that to just kind of look at your W-2 crowd, I'll call it, basically your wage-earning, tax-paying Americans, and kind of metaphorically to stay on theme here, think of the light blue line as gas in the tank for the consumer. We want to see the light blue line going up because when it rolls over, that's generally a problem. And we notice that often when we see these oil price shocks in dark blue, it tends to dent that light blue line. And if it gets sufficiently dented, that can be a problem, right? It coincides with the 08-09 recession or the dot-com bubble or the 2022 inflation spike that led to problems in 23-24. And even now we see these inflation-adjusted income trend has rolled over and softened in the last couple of months because of these higher prices. Now, the title is basically saying it's not always causal, right? Like we don't call 08-09 the oil price shock recession, right? We call it the financial crisis. We call it the housing crisis. We call it the Great Recession. But it probably didn't help that we had spiking oil prices coming into it. If we go back to 2022, we already had rampant inflation before Russia invaded Ukraine. We already had a Federal Reserve that was starting to hike interest rates and mortgage rates surging. But it probably didn't help. And I say that loosely. Like it definitely didn't help that Russia invaded Ukraine and added inflation pressure on oil, petroleum derivative products, chemicals, fertilizer, so on and so forth. And we're already dealing with some consumer stress this year, and it certainly didn't help that we had to absorb 3-4 months of higher oil prices than we otherwise would have had. So this is why it is certainly worth paying attention to. But for us, we think it is something that, while not productive, is something that we can survive. So I like to throw this chart up. This is just a median breakdown or a nominal breakdown of GDP by country. We see the United States there taking up roughly 1/4, just over 1/4 of global economic activity. We see China there in number 2, sizable gap between China and the United States, and then a sizable gap between China and everybody else. So it's a two-horse race here at the top, and then we have our pieces breaking it out. We see Germany rounding out number 3. Japan formerly occupied that spot, but because of a combination of largely poor demographics and some debt problems, Japan has been atrophying lower, which is going to be similar problems facing Germany, China, and the United States in the years ahead, demographically, moving backwards here. But I like this chart for a little bit of perspective, particularly for our U.S. listeners. There's a lot of negativity out there, but this is a chart that makes me, as an American anyway, feel all warm and fuzzy. Like I want to, I want to run like a pledge allegiance to the pie chart, session here when I see a chart like this. This one makes me feel good. And we do see that the United States is, again, still that primary market that we want to be in. So we expect geopolitical uncertainty to remain elevated in the near term. Tariffs, I didn't really talk about today because tariffs are out, trade war out, real war in. We do think that economic nationalism, whether it's geopolitical conflict, trade conflict, it is going to continue to favor economic nationalism and economic me-firstism, which we don't necessarily think is a good thing, but we're not in charge. We're just trying to break it down. And our view is that peak globalization and far-flung, vulnerable global supply chains is largely in the rearview mirror at this point. You're going to see folks opting for resiliency, albeit likely at a higher cost, out of necessity as we go forward in the years ahead. So let's pivot to the U.S. economy and look at some more granular data points here. So as far as the U.S. economy is concerned, again, the economy is growing. This weekly economic index here, this is a data point from the Federal Reserve Board of Dallas. This is a weekly data point that largely tracks what you're likely to see in those quarterly GDP reports. And specifically, it focuses on some more core components of that GDP report. And what I want you to notice is that it's doing fine. It's actually been rising. Over the last few months, it's ticked down the last couple of weeks, but it's not below zero. It's not cratering like during COVID. It is not flashing recession. It's just plodding along, doing reasonably well. Now, one of the things that makes me relatively excited about the economy is this chart right here. So this chart is showing you 2 trend lines. The dark blue line is the quarterly rate of change for GDP. So this is your quarterly growth rate or your quote unquote business cycle over time for the U.S. economy. Overlaid against that is total retail sales on a deflated basis. So essentially consumer spending less inflation. When the green line goes below zero, the consumer's in trouble. The consumer's in a recession, which generally means the economy is going to be in a recession as well. However, we saw something very interesting occur over the last 3 or 4 years, specifically in that 23-24 timeframe. So when you look at the green line, what you'll see is that the U.S. consumer went into a recession in April 2023 and stayed below zero until December 2024. In other words, we had a 7-quarter cycle where the U.S. consumer was buying less stuff, whether it was cars, whether it was tires, whether it was food at the grocery store, whether it was stuff on Amazon, the consumer was buying less stuff. Now, what you will notice is up above that, GDP did not care, which is unusual because GDP typically always cares when the consumer starts buying less stuff. If you ignore this cycle here and just run your eyes from right to left, what you will notice is that typically every time the consumer goes below zero, GDP from a growth rate standpoint is also going to go below zero and into recession. And you see all the recessions that we remember: our COVID shutdown, 08-09, dot-com bubble, early 90s, early mid-1980s. We did not get that in 23-24. Because of my earlier critique of GDP, we spent a ton of money at the consumer, at the government level. So public sector spending basically drove these numbers higher. We also saw a combination of kind of that early data center wave starting in 23-24, which was and continues to be a large growth driver. And we saw service sector activity, which is a large chunk of GDP, continue to do well. Also because services were held down in 2020 and 2021. But this created, I think, a lot of frustration and a lot of confusion for folks, and particularly industrial businesses, folks that are on what I call the make, move, sell side of the economy. So if I'm manufacturing something, I am distributing something, I am retailing something, a lot of those businesses felt under duress in 23-24. And then they turned on the news and the news said, well, what are you whining about? GDP's up 3%. The stock market's doing fine. So basically the message was, you know, quit whining, you babies. Everything's fine. And I think a lot of people said, well, I know what 2 to 3% GDP growth is supposed to feel like, and I'm not really feeling it. And this chart kind of explains why, is the components that were driving GDP were probably not driving your businesses. Those of you listening, it was not really driving the rubber uh, industry. It was more service sector driven, government spending driven, and it was more, data center AI investment driven, not necessarily consumers buying more things that have rubber in them and driving our businesses. And we saw CapEx suffer as a result in 23, 24. And I'm excited because now things are looking a little bit better. We see 1% here, which I know that's not an exciting growth rate, so bear with me, but consider the fact that 18 months ago that growth rate was 0, 24 months ago it was negative, 30 months ago it was negative, 36 months ago it was negative, 40 months ago it was negative. So what we see now is an expanding inflation-adjusted consumer environment, even with higher inflation, even with higher prices at the pump, even with pressure on savings. The consumer is still moving the ball down the field. So these are the types of data points that I leverage with my clients when I'm building a customized forecast for them. I say, first of all, turn off the news because it's going to drive you absolutely insane. It's not going to teach you anything. It's not going to give you any insights about your business. Like, we need to look at some of these hard data points that really matter to your business, and then get some sanity with that, refocus the exec team and say, okay, this is where we're at. This is what's actually happening. This is what actually matters to our business. And then we share their forecast with them and say, are you ready? Are you ready to be busier this year? Are you prepared for things to slow down a little bit next year? And then they can start getting really tactical with their decision making, as opposed to kind of flying by the seat of our pants and saying, well, a couple of key accounts say it should be a good year, so let's just hope that it is. And the sales team says this, and we kind of mash it all together like a ball of Play-Doh and say, okay, this is our budget for the coming year. Like, this is what we expect. And then, very often, almost always, that ends up not working out tremendously well. So when we look at the consumer, again, the consumer's not fine, but they're managing. There's a lot of scary consumer credit card debt, consumer confidence headlines out there. I want to show you consumer credit card debt per household as a percentage of median earnings. And I want to show you that it's higher for sure than where it was 3-4 years ago. So this dip here, this was consumers paying off credit card debt with stimulus dollars in 2020 and 2021. And then that lasted for about a year. And then credit card debt started to creep back up. But for all of the hysteria in the headlines, credit card debt per household relative to earnings is essentially right where it was, and even a hair below where it was before the pandemic, when nobody was reading alarmist headlines about credit card debt. And I think that what that reflects is, it's easy to put out a headline that says, oh, consumer credit card debt hit an all-time high. Because if you just look at the nominal total dollar value of credit card debt, it's basically always at an all-time high. Like, you can run that headline every month. And they do, but it doesn't really mean anything because we have a generally expanding population with positive inflation rates. Like, of course it's going up. I want to know, how does it look relative to earnings? Are people making payments on those debts? What is the share of minimum payments, balance payments? What is the share of full balance payments? And when you cut it up that way, it shows a slightly improved picture. And a big one I want to share here is, and a headline I want to kill, is that consumer confidence headline. So the light blue line I'm showing you here is retail sales, and I'm going to get fancy here and I'm going to draw, which is always a risk, relative to the U.S. Index of Consumer Expectations published by the University of Michigan. When you read those headlines, often this is the data set that they're talking about. And what I am hoping you are noticing, when you look at the rates of change and how expectations change plus or minus over time, and how retail sales change plus or minus over time, I hope you are noticing that the relationship is awful. It often is actually outright counter-cyclical to actual outcomes. And so we can call it out, most recently, we saw improving expectations in 23-24 when nominal and inflation-adjusted retail sales were going into recession. And then over the last 12 months, we've seen the worst cratering of expectations that we've ever seen before, while we've actually seen acceleration in both nominal and inflation-adjusted retail sales. I'll turn off the drawing before I give you all a stroke here, but it's just long story long. Consumer expectations, I don't care. I don't care how people feel, which is kind of a prerequisite to be an economist. Is like that's kind of just how you have to be, which can be problematic sometimes. But in this context, like I don't care how people feel and how they fill out a bunch of expectation surveys unless it is informative of how they spend their money. And historically, it has not been at all. Like often it's telling us nothing, and alarmingly often it is giving us an inverse view of reality. For some reason, expectations were improving during the Great Recession while retail sales were contracting. Likewise for 23, 24, and then inverse here in 25 and 6. And it really pains me to say that because, as I mentioned, this is published, it is touted by the University of Michigan, it is cycled through the headlines. And folks, I studied economics at the University of Michigan. So go blue. Turns out we're a basketball school. We're not a football school, and we're not an economic expectation data point school because this thing is rubbish and it's not helping us. So the second you start reading a headline that starts with consumer expectations or consumer confidence, just pause, take a breath, and take it with several grains of salt because often it's not telling us a whole lot about what the overall economy is or is going to do. Now, what I think will interest the folks, particularly with some tire exposure, is that it does a better job when we correlate it to, instead of GDP or instead of retail sales, if we correlate consumer expectations to big ticket consumer items, the correlation goes up. The dark blue line here is the retail sales trends in millions of units of light vehicle retail sales in the United States, which obviously that's going to be a driver of tire demand on the new vehicle side. When we overlay that against consumer expectations, instead of on a rate of change basis, a raw monthly basis here, you can see that correlation's actually not half bad. I mean, it wasn't perfect during the Great Recession where we had it going up when retail sales were going down, but if you squint, that's actually not too bad. Down, up, down, rolling over. This is the lowest, again, rating we've ever had for consumer expectations. So this would imply that vehicle retail sales should be a lot lower, which they're not. So again, it's not a perfect comp, but if I were to concede relevance to how the consumer feels, I might look at a chart like this and say, does it matter how you feel? Like, is that going to affect whether or not you go to Chipotle for lunch, or you go to Target over the weekend, or you scroll Amazon and buy a bunch of stuff you don't need? Probably not, but it might affect if we're going to buy a $50,000 vehicle or, $80,000 these days. It's ridiculous. Or maybe a house. We see this correlates well with home sales. We see it correlates well with like boat and RV sales. So like things that, you kind of have to have the means to buy, and you have to feel pretty good about your employment status, the status of the economy to ultimately go through with that. So that is the bone I will throw to the how people feel matters crowd. We do tend to see that in the data. So in the automotive market, the market is flat to mildly down, and we expect that to basically be the same. So again, if we're in the tire world and we're relying on a bunch of new vehicles getting built and for shiny, smelly new tires being slapped on there and driving a bunch of rubber product demand, we don't think the automotive market's going to help you a lot. We don't think it's going to collapse. If you look at our projections here, we think it's going to be flat-ish, mildly up, mildly down, basically blah would be the scientific term for it. It's not going to be the best ever. It's not going to be the worst ever, but it's not going to give us a whole lot plus or minus. So I offer this, and a conversation I have with my clients often is, when they're presented with a forecast like this, that like, let's say my client, 70% of their business is automotive. This can take the wind out of your sails, right? Like, so you're telling me like, we're just not going to grow for the next 3 years. And what I say to them is, well, not necessarily. What I'm saying is if you're relying on the market to grow your business, you're probably not going to grow a whole heck of a lot beyond price over the next 3 years. If you want to grow, what that means is it becomes incumbent upon you to put your hands on that economic steering wheel. And instead of riding the economic road where it's naturally going to take you, we're going to have to make that happen. We're going to have to find that share. We're going to have to create that market opportunity, which can create a lot of ROI instead of just sitting there and waiting for a good year to materialize that never does. It's like, okay, we got to do something. We've got to put some irons in the fire here. And then all of a sudden we have clients, like I had a call last week with a client that they beat our forecast by 9%, or project to this year versus last year because they're in the housing market, which is also struggling. And I said, look, you guys are going to have to make this happen because the market's not going to do it for you. And they said, okay, Connor, message received, and they made that happen. Now we're seeing that play out in their numbers, which I think is really exciting. So if we look at tire production, this is U.S. tires production. We can see that tire production is down high single digits in the United States. You can see it's been in a long-term declining trend, which I'll caution, this doesn't necessarily mean we're consuming dramatically less tires than a decade ago. This is more a reflection of less of them are being made domestically in the U.S., and we're getting some imports into the market. So it's a kind of a combination of the two, a lackluster automotive market and also imports displacing domestic production volume. But we do see this is in a long-term declining trend domestically. When we look at rubber products production more broadly, which is this data set here, we can see going back to that recession again, we saw that this was declining for a couple of years and it's actually starting to improve now. It's starting to stabilize after declining as part of that macroeconomic recession that did not show up in GDP, but did show up in some more physical goods oriented data sets. So if you're listening and if we're in the rubber world and if we're reliant on the consumer buying stuff, whether it's tires or other things, we think the economy should help us a little bit. Tires, the automotive side, is a little bit iffier, I would say, on the new vehicle side. Obviously, people like, I replace my tires on my existing vehicle, so there's certainly going to be some volume there. But in general, what we expect is a slightly more favorable business cycle for the balance of 2026 into 2027, and then starting to slow down after that. So when you look at this data trend trajectory down here, so we have rates of change up top, data trend down low, you still see a net declining trend. So really what this means for us is it's, the market consumption is not just setting all-time high after all-time high like it would have in the back half of, pretty much the entirety of the 20th century, for example, or the early stages of the 21st century. We kind of hit a peak pre-08, 09, and we've kind of been fighting to hold the tide line and seeing that recede gently over time. So our expectations for resins and synthetic rubber production is that coming out of a difficult cycle here, we're going to see that improving slightly into next year and then decelerating as we go into next year, but not necessarily setting any records. So I think we can expect a little bit better over the next few quarters, not dramatically so. Nothing that I would think would dictate, being massively aggressive if we're relying on the market. And if that's underwhelming, then really all that means Connor's just saying, you're going to have to go out and find it. Really, that is what we're looking for. So when we look at our retail sales trend against the ITR retail sales leading indicator, so this is a predictive data point that leads retail outcomes by 8 months. We actually make this light blue line because, again, we don't think consumer confidence means a whole heck of a lot. So we made a data set that leads, and it's telling us we should see ongoing consumer momentum through the balance of the year, starting to plateau late in the year coming off of this peak, but nothing dramatic, right? It's not crashing like it did prior to the Great Recession as a leading indicator. It's not crashing like it did in 2022, 2023, telling us some problems were coming. It's just it's Charlie Brown sweatering right now is what I'll call that. It's kind of that up, down, and we're going to keep an eye on this as we look through the balance of the year. So a few other things I want to get to here is, there is that narrative of, middle income, low income getting crowded out. And I do want to acknowledge that that's happening. I don't want to pretend every consumer's fine everywhere because they're not. What we're seeing is that when we look at the percentage of spend on food, housing, and healthcare as a percentage of all spending, what we see for the poorest 20% of Americans is that those three line items are now taking up about 2/3 of all spending. And that has been rising for decades, but particularly over the last several years, getting above trend here post-COVID. And that is not necessarily the case for your top 40 and your top 20% of earners, where actually that percentage has come down a little bit. It's still generally higher over the last 40 years, but we see in the last 5, it has come down, which basically means your top 20% of earners, they have more money to go around after food, housing, healthcare to spend on the stuff that they want to spend on. And so that kind of K-shape economy term that you've heard, that's what this is talking about, where more of the economy is being propelled higher by the wealthiest segment of the economy. And whether or not that's a good thing or whether or not that's sustainable in the long term is a different conversation that we don't have time for today, but it is enough to keep the economy moving forward here as we go forward. So I'm just going to stop sharing here briefly and just take us to our closing slide. And then Russ, I'll have you come back in and we'll pick off some Q&A with the time that we have left. So hopefully, folks, we're able to inject some of that as we went through. So while we queue those up, if you thought today was kind of fun, a different cut on economics and interesting, if you want, you can pull out your cell phones and you can scan that QR code there. And what that will do is just show you a few opportunities to stay in touch with ITR, whether if you're looking for forecasting help for yourselves or if you just want free updates to just say, you know what, I want to know what ITR thinks about all this. I don't want to follow the news anymore, or some other options. You can scan that and stay in touch with ITR as this crazy economic world unfolds around us. So, Russ, what do we have in the Q&A hopper? Do we have anything interesting?
My bad, I was on mute. We do have one question. What is the expectation of the Middle East war effect on the economy, especially rubber business?
So we covered that a little bit. Like we said, not productive. Obviously, a supply chain disruptor and inflation driver, particularly in the rubber world. But we do not view it as a fatal blow to the economy where the abundance of inflation pressure is going to kill the consumer, which is going to kind of create that cascading second, third, fourth order negative effects where we kind of go into a true blue recession. So maybe a little bit more supply chain disruption than necessarily it's going to kill the economy from a demand perspective. Assuming, again, we don't go back to $120 a barrel and, hopefully cooler heads can prevail here this week. That would be nice.
All right. We have another question. Why haven't oil prices shot up more and stayed there as many predicted? Once the shooting stopped, the prices went back to near pre-war.
Well, I think there's a few different ways to answer that. So, we did think they would shoot up and then come down abruptly, but I feel like a lot of the headlines folks read, like they're just trying to make a headline. Like Goldman Sachs, for example, like every time something like this happens, they just say oil's going to 200, and then it never does, and then they just move on and pretend that they never said it. And we try not to get in that kind of hyperbolic headline grabbing forecasting at ITR. So what we did when we look back at historical oil price shocks driven by war, the profile was actually very consistent. It was typically a 2 to 6 month acute shock to the upside, and then subsequent normalization thereafter. And so that's what we built into our forecast back in early March. That's kind of what we got. 2, 3.5 months high, started to normalize lower. That's actually pretty normal. And so that is what our analysis indicated was the most probable path forward, and that's what we saw. And we saw the U.S. Pumping somewhat more, but also exporting more has helped offset. We have seen rerouting some of that production around the strait through other pipelines has helped. So I would say that's why. I think a combination of some moving chess pieces and also I think it's just some bad headlines and some bad forecasts from other folks.
Okay, we've had a few others fly in here. In the tire industry, do you anticipate growth in aftermarket versus OEM demand? Also, insights into non-passenger tire business?
So I would assume because I can't get tire data by aftermarket versus new, I would expect aftermarket. Typically, when it's aftermarket anything, whether it's tires, parts, service, or whatever, it's typically pretty stable and mildly positive. And given that we think new vehicle tire business probably is going to be flat to mildly down, I would expect your aftermarket side is probably going to be a little bit better, but I wouldn't think dramatically so. For non-passenger vehicle, we're seeing that some of the freight data has been a little bit better. So I don't know if we're thinking like heavy duty truck, things like that on highway. We expect that truck production to be moving a little bit higher. We're seeing freight volumes are up. We're seeing freight rates are up, independent of fuel surcharges. So as part of that physical goods revival in the economy over the last 12 to 18 months, that has been helping freight and trucking, which should put more trucks on the road, drive some higher utilization, some more wear and tear, and hopefully that should translate to some more new tire business. And if we're thinking like huge tractor, ag, off-highway machinery, construction machinery should be better. Ag is kind of terrible right now from a new machine standpoint. So you could go a lot of ways with that.
Right. Is there any indicators where the use of tariffs reflects on new manufacturing investments coming toward the US?
Well, when we look at the domestic manufacturing volume, it has improved over the last 12 to 18 months. We thought that was going to occur with or without tariffs, and it hasn't improved like more than our forecast. I guess I'll put it that way. Like we thought we'd see some incremental improvement, and we've gotten that incremental improvement. So what we have not seen is basically domestic manufacturing volume shoot up higher than we thought was possible because of tariffs. When we look at manufacturing facility investment, it is rising. But we saw such a huge surge of domestic manufacturing investment in 2021 and 2022 and 2023 as a response to the supply chain dysfunction, the shortages, the shipping issues, that I think that might have front loaded a lot of investment that might have occurred under like the tariff heading a few years early. And then we saw that roll over. So it is going up, but long story short, we're not seeing anything in the hard data, whether it's manufacturing volumes or investment, that's like, oh my gosh, this line is vertical off the chart because of tariffs. And at this point, and that's kind of what we expected. We don't think tariffs are a particularly great policy tool, and so far the data, we didn't think it'd kill the economy, which didn't happen either, but we didn't think it would necessarily drive us to new heights.
Looks like we've got three more questions. How should these developments inform CapEx investment decisions in rubber manufacturing?
I think if we're investing, we're doing it now. Ideally, I could have talked to you a year ago and said maybe we do it last year because we've seen and we expected that inflation would pick up this year, prices would pick up this year. You know, you always kind of like want to invest into a growth cycle, and then you kind of take your foot off the gas at the top. We don't think we're at the top yet. We do still think we have some positive runway to lean into. So if maybe we were going to do something, then last year we're like, oh my God, the tariffs are going to end the world, so we're going to punt. And then it's like, oh my God, there's war in the Middle East, so we're going to punt. I think you can have some confidence. Like if you do have some needs, we can probably do that now because just realistically, you're not really doing yourselves any favors by waiting. So it's like if there's like a definite like capacity born need there, or it's just like we just have some aging capital stock that like we're just holding together with like duct tape and rubber bands at this point. Like waiting isn't really going to do you any favors because we think we're going to be seeing sustained higher inflation rates for the next 4 or 5 years, and we also think interest rates are going to stay high. So for financing, it's our opinion would be it's probably just you're going to get less time to get ROI out of it, and it's not really going to be cheaper or anything.
Okay, we have time for one more question, and that is, how about the forecast of AI infrastructure investment? How steady can it maintain growth?
In the short term, it's going to keep going. There's just so much permitted. There's so much in the backlog. There's so much in the pipeline. Short term, call it 18 months. I think it's pretty safe. However, my worldview, which is informed by 12 years of work experience in economics and looking at decades of historical precedent, hundreds of years, generally, if it walks like a bubble, it talks like a bubble, it's a bubble. And so it's a question of when it's going to pop. So I don't think it pops this year. I think we are starting to see some friction in that market, some struggling monetization from these AI platforms, and kind of companies looking at their AI spend and seeing their eyes pop out of their head at the bill. So I don't know if I want to say a reckoning's coming, but I think we're going to see some sand start to slip into the gears from a growth rate perspective as we move forward into 2027. So I know that's kind of like a lame non-answer, but I'm not prepared off the cuff to say the bubble's going to burst in May of next year. But when you see market activity like you've seen, it's generally a shoe generally drops. I don't think it's going to happen too soon, but again, follow along with us, subscribe with ITR. It's something we're talking about all the time because it's a really, really key piece of the economy right now, as I'm sure you can appreciate.
All right. Well, Connor, thank you for the rapid fire Q&A answers. And we definitely thank everybody for their cooperation and excitement in asking questions. Sorry we couldn't get to all of them, but with that, that concludes today's webinar. Connor, thank you for being part of this webinar and sharing your vast knowledge, and also to our webinar sponsor, HF Group, and to everyone joining today. You can check out our upcoming training opportunities at rubber.org/training, and have a great remainder of your day.
All righty, folks. Thanks so much.
Thanks, Connor.